global rates, the global bond sell-off. We kind of understand what's going on here, but are we entering, Matt, in your view, a new era when it comes to the global bond trade?
We're not overly concerned about it, particularly from a U.S. perspective, right? If you think about it, what Japan is going through now with the BOJ being a little bit behind the curve, catching inflation, we've been through that. We got through that 5 years ago. The best way to look at it's real yields, right? Inflation-adjusted yields. Not exactly, but approaching 2% on 10s, approaching 2.75, getting close to 3 on 30s. That looks great relative to the rest of the globe, right? Rest of the globe, you got Germany probably 75 basis points on 10s. You got Japan 35 to 50 basis points. Our real yields look quite attractive here. So if there is more of a sell-off, expect it more sort of in the developed markets around the world, not as much in the U.S. We've already adjusted to higher inflation. Now, I'm not saying there's not more upside here.
All of it? Like how do you factor in the war? Are you we've been trying to assess what we got from Fed Chair Jay Powell yesterday about kind of looking through the energy shock, but time will tell, right? Whether or not this is a longer problem.
Well, time will definitely tell whether this is more of a problem. And you can look at it sort of either way, right? We were joking before. You could look at it that, energy prices are inflationary. All the spending on AI CapEx is inflationary.
Right.
We haven't hit the PCE target in 5 years. Can't hike rates, right? You got to hold them steady. Or you can look at it a different way. You could say, actually, productivity is going to come through and it's going to lead to higher growth. You saw that in the S&P. They ticked up a little bit in terms of their expectation for growth. You can say, actually, AI is going to be slightly disinflationary. And you can say, gasoline prices, energy prices up over the short term, much like we talked about tariffs last year, doesn't necessarily lead to economy-wide inflation. It's inflationary pressure, but you need spending on everything else at the same level and those higher prices to generate it. So we're not overly concerned about long-term inflation from a near-term spike in energy prices.
Which of those two views do you think is right?
It's a Rorschach test. You'll learn.
I mean, those are two totally
right.
Yeah, and look, it's
you're going to learn more about me from that answer than you're going to learn about what's going to happen in the economy.
Sounds like a man trained in the liberal arts, but truly, I mean, which one is more likely?
That's a tough place to be, too.
So I'm being flippant, but I mean this because you can be a policymaker on the FOMC. And you could have a principled view, depending on which mandate you think is which is more important. Is it maximum employment or is it price stability? So the question to me is not as much what is the right answer or what is my answer. What is the Fed chairman's view? What does he think?
Which Fed chairman?
Assuming, and by the way, I think Powell obviously is a professional, did a wonderful job yesterday. He is setting up the next Fed chairman, if there is a next Fed chairman near term, he's setting him up to be able to do whatever he wants.
Wait, I think it's even wild that you even said if there's a new Fed chairman.
In the near term, it's possible. Okay. Chair Powell said himself yesterday that he's unlikely to step down if there is not a resolution to the legal challenges. So it's certainly possible, as he said yesterday, that he stays on pro tem. But let's assume we work through this.
At some point.
We work through this, and Kevin Warsh gets appointed and nominated. The real question is, what's his view? His view's been clear. He believes, and we've talked about this at Chief Investment Office, whether it's CIO, Chris Heisey. This feels a lot like the mid-'90s in a lot of ways. We had a doubling of the Fed funds rate from 3 to 6 in 94. People worried about, the yield curve inverted, a recession's coming. Everyone nervous. Didn't happen. Greenspan correctly pivoted. We had the longest recession at that point in economic history, and tech took us through. It feels very much like that now. That we've had that bond bear market from the hike in rates. We might get a productivity boom. And folks, let's break it down here, right? This 2% inflation target, it is not based on U.S. financial history. It's got zero, zip, niente, nada.
But it's still a target.
But it is a target for now. They haven't hit it in 5 years. The average inflation rate in the U.S. and CPI has been calculated is 3.3%. So there's nothing to be overly concerned about, except for the target on a 3% inflation rate. Nominal GDP, the stock market, the economy, corporate profits, spending, income, they all do fine at 3% inflation. So it's really a choice for the Fed to make. And again, as I'll say it again, Powell's a professional and is setting up a new chair to be able to position it how he wants. He's not thumbing the scale in any way.
Well, so how does a new Fed chair, how does a Kevin Warsh as Fed chair want to see things progress? I mean, do you see the rate path differing if this was indeed the second to last meeting that Fed Chair Powell decides over?
Our belief for now is that you're probably going to get another 2 cuts this year, right? We saw how candidate Warsh presented himself. And again, he's giving that story that looks much like the mid-'90s, that AI is going to be productivity enhancing and will allow further U.S. economic growth that's slightly disinflationary. That is the 90s parallel. So to your question, Tim, is whether that's right or not, you're not going to learn near term, but that's his view. And so we expect him to at least try and deliver one rate cut before the midterm elections. That's November. So we got June, July, and September to deliver one rate cut, right? So expect one, and then maybe another one before that.
But if everything is so good, Matt, taking out
I didn't say everything was
well, but you sounded like earnings. You talked about a lot of good things that were going good. Why do we need a rate cut?
I said in an inflation environment of 3%, all those things are still fine. I'm not saying the economy right now is fine. The economy right now has issues.
Right.
The slow growth job market is a significant issue that might need a rate cut or two to address. Again, but that's not when do you really worry about an economy? Not when job growth slows, when people started getting fired, right? And we're not seeing that in unemployment claims. We're still ticking around at 200, 250.
Low fire.
So in the again, when people start to lose their jobs or afraid their wife's going to lose their job or their brother, then people retrench. We're not seeing firings, right? We are seeing slow job growth, so it's not necessary for the Fed to move a lot either direction.
But do people retrench if they think gas is going to be $1 more a gallon than it's been for months?
Absolutely. If it goes up and stays there, but that's not what the oil market's telling us. It's telling us the first month contracts, almost doubled.
Yeah.
But not the 12 month.
Yeah,
it's only up $10 to $15.
Yeah,
the market is saying
he's been obsessed just watching the
right. The market is saying again, and the market is smarter than me. It's telling you. It doesn't tell you what the resolution is going to be, but it's been pretty clear that this is not going to be, in the market's opinion, not a sustained increase in energy. And again, you would need that sustained increase, and you would need the consumer to spend just as much on everything else to keep inflation-wide problem across the economy. Consumers will only do that if they dip into COVID savings, which they don't have. Spend a lot more real income, which they're not getting, borrow against their houses to fund consumption like they did in 06. We're not seeing that. So again, energy is an inflationary pressure, but to create inflation, people need to spend as much on gas and the same on everything else. If gas prices go up, they could retrench. It could create demand destruction for the rest of the economy. Energy prices can in some way act like a rate hike, believe it or not, right?
Yeah, absolutely, right? So, okay, 30 seconds. So what's your advice to investors?
Our advice to investors, again, generally speaking, we're not saying investors have to be tactical. If they want to be strategic and hold a portfolio, not move it, that's fine. If they want it to be tactical, we are positive on the economy. We're very, very positive on the U.S. versus the rest of the world. The more dangerous the rest of the world gets, the unassailable competitive advantages the U.S. has, demographically, geographically, institution-wide, education-wise, we are believers in the U.S. So we're overweight U.S. versus the rest of the world. We're underweight fixed income, not because we don't like fixed income, but just to fund our equity overweight. We're not long or short duration.
Interesting.
We want to be neutral duration right now, but if you're looking for opportunities for high tax rate investors, long munis look quite attractive at the moment.